Look at your screen right now and tell me if your hands are shaking yet. 1929, 1965, and 2000. Those are the 3 years that defined financial misery for generations. Those were the peaks, the moments where everyone felt like a genius right before the floor fell out. In 1929, it was an 80% drop that triggered the Great Depression and left people jumping off buildings. In 1965, it was a decade of total stagnation where your money just sat there rotting. In 2000, the dot-com bubble burst and wiped out trillions of dollars of wealth faster than a bad breakup. And here's the punchline. Today, we are trading at valuation levels higher than every single one of those periods. I am not just talking about a little bit expensive. I am talking about historically record-breakingly expensive. Now, I know what the bears are saying, and I know what the permabulls are screaming, but valuations are not a timing tool. They are a gravity check. If you overlay the stock market history, extreme valuations have a perfect track record of signaling major peaks. But something is very different this time, and it is making the experts look like absolute idiots. Usually when the world starts shooting at each other, the market takes a massive dump. During the Gulf War in 1990, valuations were in the basement compared to today. After the 9/11 attacks, people were terrified and valuations were far lower. But today, right in the middle of actual military conflict between the US and Iran, the market is hitting all-time highs. It is like the SP 500 decided to go to a rave while the rest of the world is preparing for a bunker. This is not how markets typically behave, and it is confusing the hell out of anyone with a textbook. The downside is that when sentiment eventually changes, the drop is going to be a lot more painful because we are so high up. We are using a metric that combines the PE ratio, the price-to-book ratio, and the famous Buffett Indicator. The Buffett Indicator is basically the total market cap divided by the GDP, and it is screaming red. By almost every measure, US stocks are expensive, and there is no point in lying to yourself about it. Over the past 15 years, we have barely seen any meaningful valuation reset at all. It has just been a straight line up, fueled by cheap money and a lot of hopium. But before you go selling everything and buying gold bars to hide in your backyard, listen to the other side. There is a massive reason why stocks might actually deserve to be this expensive. Corporate profits in the United States have more than tripled over the last 15 years. This is the fastest profit expansion we have ever seen in the history of capitalism. From the mid-1990s to 2010, profits only grew by 100%. But since 2020, even with a global pandemic and an inflation shock, earnings have kept up with prices. Corporate America has become a resilient, profit-generating machine that doesn't care about headlines. As long as earnings keep rising, these crazy valuations can stay elevated indefinitely. But if corporate profits start to roll over, even a little bit, it is going to be a bloodbath to see where we are going. We have to look at corporate profits as a percentage of GDP. Historically, the only time we see a real market crash is when profits contract as a share of the economy. Right now, corporate profits account for roughly 12% of the entire US GDP. That is the highest level recorded since 1947, which was right after World War II. The historical average is only 6%, so we are literally double the normal amount. If this number drops back to 6%, the stock market valuation will get cut in half. And the single most dangerous factor that could trigger that drop is the corporate tax rate. In the 1950s, the government raised taxes from 38% to over 50%. Unsurprisingly, profits dropped from 10% of GDP down to just 4% by the 1980s. Then, the government flipped the script and started cutting taxes for 40 years. We went from 40% corporate tax rates in the 80s down to just 21% today. This policy shift is the secret engine behind your VO and SCHD gains. If that tax rate goes back to 35% to fix the massive budget deficit, the party is over. The US government is spending way more money than it earns, and they are eventually going to come for the winners. Raising taxes slows down investment and kills economic growth. But it might be the only way to save the dollar. The current administration is fighting to keep taxes low until at least 2028. So as investors, we are operating in the most favorable tax environment in modern history for another 2 years. This means the market might stay expensive and elevated much longer than you think is possible. Stop waiting for a 50% crash every time a news anchor looks worried. Market pullbacks will likely stay shallow as long as the tax environment stays this friendly. Your job is to predict the end of the world. It is to follow the money. When corporate profits represent a record chunk of GDP, you need to find out where that money is being spent. Right now, a massive chunk of this capital is flowing directly into the AI arms race. We are talking about the companies building the infrastructure, the nuclear power for data centers, and the copper mining for the grid. Roughly 40% of my own research exposure is in the nuclear power and energy infrastructure sector. If you want to know which specific stocks are positioned to eat this capital, there is a link in the description. But the bottom line is this. Don't let the big scary valuation numbers paralyze you. Understand why the market is high, watch the tax rates, and keep your head in the game. The 1929 crash happened because the economy collapsed, not just because stocks were expensive. Today, corporate America is a beast that is still eating everyone's lunch. Stay invested in low-cost SP 500 index funds, but keep an eye on the exit door in 2028. If you are sitting on a pile of cash waiting for 1929 to repeat, you are losing out on the greatest profit cycle in history. The market can stay irrational longer than you can stay solvent, but it can also stay expensive longer than you can stay disciplined. Don't be the person who missed the 300% gain because you were afraid of a 10% dip. Calculated risk is the only way to build real wealth in this environment. Audit your portfolio today and see if you are actually exposed to the sectors that are making money. Don't hold on to legacy companies that are getting left behind by the AI shift. Look at the tax location of your assets, because when the tax rates go up, your Roth IRA is going to be your best friend. The government can change the tax rate on your 401k whenever they want. Remember that. We are in a structural uptrend until the policy changes. When the policy changes, I will be the first one here to tell you to run for the hills. But until then, we stay aggressive and we stay smart. Hit that like button if you want more of this real talk macro data. Drop a comment and tell me if you think we are in a bubble or a new era. Subscribe so you don't miss the update when the 2028 tax trap starts closing. I know you guys are working hard for your money, so don't let a lazy headline take it away from you. I am reading the 10KS in the budget report so you don't have to. This is about being a bull or a bear. It is about being a realist. The realists are the ones who get rich while everyone else is arguing on the internet. I've got my eye on the nuclear energy sector and the base metal miners for 2026. The energy demand for AI is going to be unlike anything we have ever seen. That money has to go somewhere, and I am positioning myself to be there when it arrives. Go check out that premium report if you want the exact tickers. Otherwise, just keep your expenses low and your savings rate high. The best investment you can make is in your own financial education. Thanks for sticking with me through the boring parts of the tax code. It is where the millions are made. I'll see you in the next one when we look at the housing market disaster. Stay sharp, stay humble, and keep stacking those shares. The finish line is closer than you think if you know where to look. Peace. Seriously, look at the Buffett Indicator again. It is a scary chart. I get it, but a scary chart doesn't pay your bills. A growing portfolio does. Don't let the fear of a 1929 repeat keep you from the 2026 gains. History is a guide, not a prison. We are in uncharted territory with global liquidity and corporate margins. It is a weird world, but it is the world we have to invest in. If you wait for the perfect valuation, you will be waiting until you are 90. Buy the dip, hold the winners, and cut the losers. That is the whole game. The rest is just noise. I am going to go have a cheap coffee and look at some more spreadsheets. See you later. Peace. One last thing, watch the oil prices. If oil spikes and stays high, that is the one thing that can break the corporate profit engine faster than taxes. Energy is the input for everything. If the input gets too expensive, the margins collapse. But for now, the energy infrastructure stocks are the ones winning that trade. Okay, I am actually leaving. Now go make some money. Peace out. Seriously, don't buy the hype, buy the data. The data says we are expensive but profitable. It is a fine line to walk, but that is why we are here. Keep your stop losses tight and your goals long-term. Talk soon. Bye. Wait, I almost forgot. Check your account mix. If you are 100% in a traditional IRA, you are literally a business partner with the IRS, and they are not a silent partner. Start looking at Roth conversions while taxes are still at 21%. This is the lowest tax environment you will probably see for the rest of your life. Use it. Okay, now I am really done. See you. Peace. One more. Don't forget that 12% of GDP number, that is the North Star. As long as corporate America owns more of the pie, the stock market will reflect that. If the people start taking the pie back through labor unions or taxes, then we pivot. Right now, capital is king. Stay on the side of the king. Peace. End of script. I hope you enjoyed the deep dive. Let us get after it. DDO7 out.